Well, hello everyone. Thanks for joining me. Let's put the disclaimer here first. On stage, obviously not investment advice. I'm not an investment advisor, but I'm going to be using public domain slides just to kind of look at Meg's presentation, which reaffirms support for the Cenovus transaction. And then we're going to be looking at the Strathcona response from the public domain, what these guys were saying as a response to the September 15th presentation that we're going to review right here. So hopefully everybody's happy about this. I see we have people joining us. So we've been live about 3 minutes now. But yeah, very important, you guys mindful of this is not investment advice. It's just for information purposes only. And this does not constitute investment advice. So I don't provide recommendations. I'm just a dude. And yeah, use it as an information and entertainment. If some of you want that to use as entertainment, I'm not sure if I need to go do also like a space, but we'll just kind of stick with this for now and see how it goes. I'm going to review some of the slides when it comes to MEG and Strathcona response from the public domain as mentioned. So, okay. Yeah, I'm not sure how big this is going to be, this space or this session. Maybe we'll share a little bit more with some more people. So share on X. Here we go. Let's share this so we have more people joining. All right. Okay, how is everyone doing? Hopefully everybody is doing okay. You can make comments here, and have a couple of people joining us, which is great. And maybe I'll start a space as well on Twitter. MEG. Okay, well, thanks everyone for joining. Also gonna do a space, I guess. And live here with the slides. Like I said, not investment advice. The disclosure is on YouTube. Yeah, please watch it and make sure you're aware of what's going on. We're going to be sharing public domain slides only, and yeah, very important to be mindful of that. So we have about 10 people watching this live. We're going to start by talking about the presentation by MEG Energy, and then we're going to go to Strathcona, right? Obviously, there's lots going on here, lots of dynamics. I'm going to be trying to be fair and kind of not express my views, but talk to what each company is basically suggesting about what's happening. But if we were to provide kind of an overview of what took place, what actually happened is that September 16th, right? So MEG Energy, and which is, by the way, it's the remaining pure play oil sand producer. It's pretty much in the center of competitive battle right now, right? And we know that. And what's been going on is that they entered into a definitive agreement on August 22nd to be acquired by Cenovus, right? And in a cash and stock deal valued approximately 8.2 billion. Now, the company is producing today about 109,000 barrels a day. But they've been kind of fluctuating around the standard deviation. So they produce, let's say, 100,000 as a baseline. So the price basically suggests that it's about 80,000 per flowing. And we know companies developing today brownfield assets for maybe 25,000 per flowing, maybe 30,000 per flowing. We know some greenfield modulated expenditures are closer to 35, 40,000 per flowing. So that acquisition is kind of double that, which makes a lot of sense, I guess. And this acquisition price, including the assumed debt as well, and implying about $28 per share based on Cenovus's closing price, in September 12th. And the transaction has been anonymously approved by the boards of both companies, so MEG and Cenovus, and under the Business Corporate Act. So, but the deal really faces opposition from Strathcona Resources, which initially launched the hostile takeover bid in May 2025. And I think, in overall, I think it's pretty good for the sector that it happened, because it really kind of got things moving in a positive direction when it comes to understanding that maybe some of these assets are undervalued, and kind of gave momentum maybe towards other companies, maybe from a broader kind of generalist perspective, to appreciate maybe some of these companies were undervalued. And so there's a lot of attention that I think it's overall is a positive for the sector. All right. I misspelled the space. All right. Yeah, guys, if you listen to me on Spaces on Twitter, you can join live on YouTube and see the slides that I'm sharing and the disclosure there. So this is kind of like a quick review of what took place. Now, what happened since is that Strathcona, it recently sweetened the offer. So it kind of came back the second time after that strategic review that was taking place between MEG and eventually Cenovus kind of agreeing to have that ultimate deal. And Strathcona, what they did, it seems like they really want MEG. And so what they did, they revised the offer to all stock and cash proposal. And then they provided some more kind of insights towards how that value is more superior to the deal that was announced between the two companies. So by the way, we have more people joining to the space. You can obviously go on YouTube and watch this live. So MEG's board and special committee reaffirmed support for the Cenovus transaction as of yesterday. And they published a slide deck on their website. This is the one I'm sharing on YouTube. And they're going to share the Strathcona response as well and kind of talk to the topics and discuss of what's being shared in the public domain and see if people have any comments and provide some insights based on that. And since then, also, Strathcona took a big position in MEG, so further buying shares, and explicitly recommending that shareholders reject basically the merger or acquisition by Cenovus, right? So they say they're against it, and those are the slides we again going to go over after we're going to go over the MEG slides and kind of have more of a discussion, I guess, on this. And again, this is kind of one way me talking, but I'm live on YouTube, so that's going to be a challenge integrating more people to the space because I'm on YouTube now, going live talking about the slides. So I encourage everyone to go there. Okay. Tracy moved over here. Welcome, Tracy. Welcome, welcome. So we're going to go over the slides, kind of have more of a detailed overview. I'll try to provide some kind of, views on what I'm seeing, but, obviously it's a very sensitive topic here. So, okay. So September 15th, reaffirming support for the Cenovus transaction. So this is the new slide deck. Superior value, lower risk, best choice. So in this slide, we can see them advocating for the Cenovus transaction and saying that it's more superior value, less risk, best choice. And again, to be fair to Strathcona, we're going to review their follow-up. MEG board recommendation, vote for Cenovus transaction, Cenovus' transaction, and reject the revised Strathcona offer. So that's from MEG sides. And they basically have three main topics here that they address. They talk about the Strathcona revised and extended its offer to acquire MEG. They talk about the revised Strathcona offer, which in their view fails to address significant risk for MEG. And they provide a recommendation to vote for the Cenovus transaction and reject the revised Strathcona offer. So in summary, September 8th, Strathcona revised and extended its offer. This basically changed to going 0.8 Strathcona shares per MEG share, and MEG shareholders to own 43% of the combined company. And the Waters Energy Fund will own 48%. Increased synergies due to entirely to higher leverage pro forma, and special distributions of $2.1 billion that was also revised, I think, from $10 per share initially, then to $5 for the combined company. And it really does not increase offer value. That's what they're saying here. So Strathcona willing to enter into lockup, no details provided on scope or duration, and may only delay risks to MEG shareholders. So that's kind of what they're saying. The other thing they talk about here is that revised Strathcona offer fails to address significant risks to MEG. And I think they go a little bit more into kind of details here. And I think the main value really here is you never see a company talking about another company in the public domain, and especially talking about the company that's going to be acquiring that company and the company that's attempting to acquire that company. And so we have very kind of unique insights towards a view of how this company is seeing that situation, right? So they go right ahead and they say, look, they have inferior assets to ours, unproven track record, smaller geography, and dispersed assets. And what they're alluding to really here is that MEG Energy, they have one big, basically region, a big central process facility. In fact, those are two main units, so CPF1 and CPF2. But it's very concentrated around the Christina Lake region. So very concentrated. Where Strathcona, they really they disperse. So they have Orion, they have Tucker, they have Lindbergh, they have assets all over Saskatchewan when it comes to their heavy oil plays. And so they basically say, look, we have this one place. How can you compare even your assets to ours? What they're also saying is that the Strathcona shares are overvalued in their slide deck. And again, I'm on YouTube showing the slides. They suggest that the shares that trade actually at a premium, 30% premium to NAV, and analyst targets prices below share price. So they basically take the analyst community and they say, look, this guy suggests that the share price is on the higher end of where it needs to be. They talk about higher debt with special distribution, which suggesting that it's riskier, more levered company. They talk about that WEF overhang risk remains high. They talk about 6.2 billion position, future LP selling would likely pressure share price. This is obviously an assumption they're making here. And significant governance risk, water energy fund may not act in interest of minorities. So that's their argument based on the slides that they share in the public domain. So now they basically guide and say, okay, so that's why I need to vote for Cenovus and reject the revised Strathcona offer. And they provide 4 key points. They say Cenovus transaction, the preferred outcome of robust strategic review, received multiple proposals. Cenovus improved its proposal twice. Participation in significant synergies. So then basically the synergies will be 400 million annually by 2028. I personally saw some people, it's fake news that we saw on Twitter when it comes to that Strathcona has adjacent acreages next to MEG in the Christina Lake region. That's not true. They don't. But Cenovus does. And so what they're talking about is that as they combine the central process facilities and integration towards field development in the region, they will be realized 400 million annually by 2028 and 400 million in synergies, which adds additional value. They also talk about superior upside potential because of Cenovus, right? And they say here that the share price is currently a 20% discount to NAV. So now they're basically creating almost like a baseline and say, look, the analyst here, they say that the target price is below share price for this company, but for this other company, the target price is a 20% discount to net asset value, and the analyst targets is 24% above share price. So basically, they're taking a future looking approach, saying we appreciate what's happening right now, but where are we going, and what value is going to be created for investors. Accelerates MEG standalone plan, and again, this is within the context of that synergies and developing the broader asset. I think the name of the asset in the north of the lake is called Narrows Lake. So they're basically saying, okay, within there, we're going to be able to capture more value and more certainty of the value and robust liquidity. So 73% in cash and 27% in Cenovus shares. So there's more value proposition from that perspective that they suggest. So we did see lots of comments when it comes to people sharing their thoughts, saying, look, they offer maybe 10, 11% more in the second offer, but it seems like based on this presentation from MEG is that their approach here is more forward-looking. So they're saying, we're making assumptions based on what's happening today and how shareholders of the future may benefit. So I guess that's the approach they're taking. Okay, so this slide Three. By the way, I'm on YouTube now showing the slide deck, provided all the disclosures from my perspective, right? We're talking about public domain slides and sharing the views from both companies to provide an update to the community about where both companies are standing as of today, because we have a fresh new slide deck by Meg from yesterday, and we have a response from Strathcona. So we're going to be fair to both companies, and we're going to present both and talk about them. So here we have a comment. I'm going to show it. PJ says, how does the 400 million synergies benefit MEG if the acquisition is 75% cash? MEG board seems to be speaking as if they already CV owners. Fair comment. I think the perspective here, thank you for that, PJ, by the way. I think the perspective here is the synergies could be realized from the fact that there is more to be done with the asset itself as you look forward. And then there is key assumption that the paper is undervalued, right? So that's kind of the core idea in my view. Now, the entity will be able probably to, as you think about the broader Christina Lake area, the entity probably going to be able to tap into the net asset value around the lake and maybe pursue more less heterogeneous reservoirs, maybe more homogeneous, kind of better oil production rates, and utilize those combined facilities for that purpose. And obviously, because it's north of the lake, those assets could be, this infrastructure could be utilized to kind of improve the entity further. So there was an argument, which I think is fair, saying, well, how come MEG shareholders cannot capture more of that value right now? And this could be a fair statement, but we don't know. It's kind of future forward, kind of forward-looking maybe assumption of how that value will be realized. And I assume that 400 million synergies benefit came with certain assumptions, and you would agree with me, PJ, right? That maybe oil price being assumed at a certain level, differentials to WCS assumed at a certain level, and that those synergies being realized at that number. But nothing is guaranteed, obviously, with the target of 2028. So this was, again, this slide, a lot to kind of unfold here. There's some small kind of letters, description there, and assumptions on how it was made, the slide. But, I'm kind of a little bit uncomfortable even talking about this. But because it's in the public domain, let's go over that slide and really see what some of the considerations and what some of the kind of assumptions that were made here. So they basically keep saying, look, our asset is much better. And again, I think they come from the perspective that they wanted nothing to do with even transacting with anyone. They were just placed in display. And out of the two options, I guess, now that they're in the market and they have to go in a certain direction, right? Some people were saying, well, if there is no transaction, the stock would go back to like $21 or whatever. I don't think necessarily it's the case, but it is what it is. And so now they're in play, and they already agreed to a certain level of path forward with Cenovus, obviously. So that's kind of what they're talking about here. So they again suggest there is unproven track record, overvalued shares, and the fact that WEF ownership very concentrated, there is risk, right? When it comes to comparison of consideration, they basically talk about the transaction with Cenovus, which is 20 in cash, and 0.33 Cenovus shares, which is about $28. And then the revised offer is 0.8 Strathcona shares and $4 in cash, right? Which is kind of closer to that $30 mark. But again, a lot of key assumptions here are associated with kind of forward-looking production, for paper value, things like that, right? So that's kind of what they're talking about in the considerations for the board. So let's kind of go over one by one and see what they're saying. So the assumption here is 27% of the consideration is Cenovus shares, right? And Strathcona shares, 100% of the consideration. and they compare them, basically side to side, right? So they say, okay, when it comes to the asset, in situ asset quality. So here they talk about lowest SOR of peers. Now, this is something that's kind of very interesting on Twitter, because people that are not technical in nature don't really care about this. This is one of those things that people are very uncomfortable talking about SOR. People maybe don't understand SOR. In many cases, people say it's not an important metric. Interestingly enough, MEG puts it always as number one kind of thing. And I think it's really important to consider, because now we have referred Cardinal Energy, the developing an asset, and they will be utilizing steam to produce the bitumen, because it's too viscous to flow, and you need to inject steam, so heat, to transfer that heat and drain that oil by gravity. In a way, steam in SAGD, or this recovery schemes, is what fracs are in for the Permian, right? So fractures yield drainage by pressure gradients. In steam-assisted gravity drainage, steam utilization yields oil production. And the lower the SOR you have, the better your kind of optimization is, the better your economics are, the more superior kind of your utilization of energy is. For example, if you were inject 3 barrels of steam to produce 1 barrel of oil, is not as good as injecting 1 barrel of steam and producing 1 barrel of oil. So SOR1 will be perfect. SOR2 is better. Here they talk about SOR 2.4 in the kind of broader entity. But then they basically say about Strathcona that it's among the highest SORs. So average SOR, based on their calculation, is about 3.9. And I assume that number came from Lindbergh, Orion, and Tucker over a certain period of time, right? So about 3.9. Then they talk about production. Production, 766,000 barrels per day, being largest in situ producer, versus 109,000 barrels per day, or BOEs per day. Smaller modular assets. Again, we're talking about one big concentrated asset. Same applies to Cenovus, right? Cenovus will produce about 200,000 to 250,000 barrels a day in Christina Lake, Foster Creek, right? An asset like Sunrise will be about 60,000 barrels a day, but the Firebag will be like 200. So those are not, or 250, those are not modulated assets. Those are big central process facilities that are very concentrated in one area and can process a lot of oil. When it comes to modulated assets, they're a little bit cheaper, but they concentrate on a very small area, right? So there is this kind of, they talk about this value that you can, by integrating the CPF, you can materially improve the overall kind of Christina Lake region. They talk about implied NAV upside. So the assumption is basically based on the analysts, and they say that Cenovus shares are undervalued by 20%. And again, look at my disclosure. This is, again, from the public domain. Again, guys, on Twitter Spaces, go on YouTube if you want to see the slide deck. And I have all the proper disclosures there. And about the Strathcona paper, they say it's 20%, 30% overvalued shares, right? So now it's kind of like, okay, as I said before, they're looking forward, so forward-looking assumptions. And now they're looking at the brokers, a percent of brokers based on buyer recommendations. So 100% of them say highest among peers, 100% to buy Cenovus, only 20% say second lowest among peers to buy Strathcona. Then they talk about overhang risk, which is none. It's Cenovus case, 6.2 billion in water energy fund ownership. Governance risk, so 12 independent directors for Cenovus, only 3 independent directors of 9 in Strathcona. Major shareholders, long-term, invested since 1986. And Strathcona, they talk about serving LP's interest. That's what they share. And again, those slides are a little bit uncomfortable, right? Like I'm even talking about this, it's kind of like, oh, it's like very direct language, right? But again, this is something that as a community we can look at and discuss and to be fair to Strathcona, we're going to look at their response because they're going to have very similar type of language there as well. Shareholder base for Cenovus is diversified blue chip and Strathcona concentrated, not traditional. So that's what they say in the slides. Again, very direct language, very kind of, very direct explanation. So one doesn't have to guess. So in this slide, we can see how SOR, I talked about SOR, steam to air ratio. Again, steam utilization is extremely important. If you think about energy utilization, right, what that enthalpy that comes in and transfers the heat to oil to be drained by gravity, the more you inject, the less economic and environmentally friendly that is. So they're very proud of that metric. And again, people on Twitter can discount it, say, okay, I don't care about SOR. SOR is not important. In the sector, from a very technical perspective, managerial perspective, it's a very important metric, right? I grew up on this metric being one of the most important metrics, and it's kind of weird to hear that people even say it's not important. So here they basically say leading SOR for the combined entity, about 2.4 as they mentioned. You have different peers, and I think they provide some of those peers. I think they use Athabasca, Canadian Natural, Sinuk, among others, from Enver's data, and Suncor and Imperial, and they basically say, hey, Strathcona, you're kind of closer to 4. So you're between 3.5 to 4, we're 2.4. And again, this is kind of a big difference, right? So if MEG will use, or the combined entity will use 2.4 steam to air ratio, this guy's closer to 3.8, 3.9. Obviously, they could make optimizations, right? But the geology could be a little bit more heterogeneous, and that's the reason for the higher steam to air ratio. Now, to talk about superior cost structure. So in situ operating costs and sustaining capital expenditures. I personally was in presentations in the past where Suncor executives were talking about how MEG's operating costs are the lowest in the sector. And this is kind of what they're showcasing here, where it's about $20, right? So much lower, they're suggesting here in comparison to others. And the other one, Strathcona, is about 30 based on what MEG is sharing. So, and then they promote the concept of significant synergies with Cenovus. So MEG shareholders will participate in significant synergies, 150 million annually near term, over 400 million annually by 2028. Acceleration of production growth. Again, thinking about the broader Christina Lake asset, plans to spend an incremental 400 million in capital, 150,000 barrels per day capacity in 2028 versus 135,000 barrels per day under the standalone plan, which kind of tells us that the brownfield expansion they're doing is going to continue. That will be strategic to the plans. This could be news for many people because we have some people were suggesting that they should have been focusing on buying shares versus brownfield expansion. But what we're hearing from here is that maybe they have this agreement that they're going to continue growing the bottleneck and kind of bringing more of their facilities to expand production in Christina Lake for MEG. And maybe there's an opportunity even further to optimize and grow to 150,000 per day on this asset. Now, again, just to remind you, production rate now is about 109 for last month, at least from what was reported. And the average production is about 100,000 barrels per day. Superior synergy to Strathcona. Cenovus positioned to maximize synergies with integrated development across Christina Lake assets, credible estimate derived in collaboration with MEG. So there is kind of broader look at how we're going to develop that region versus kind of pocketed development as an add-on basically to Strathcona's ongoing operations where geographically it's not really close by. Okay, so Strathcona has not demonstrated organic heavy oil growth. That's what MEG is saying in their slide here. M&A focused company that has overseen a decline in its heavy oil production post-acquisitions. Interesting, right? again, a lot of direct language, right? I'm presenting those slides and I'm talking about them, not necessarily comfortable, right? But it is what it is. Strathcona's heavy oil segment has failed to grow. And what they're saying here is that there was this big transaction between Serafina and Strathcona, many friends that used to work there, and they kind of adding those assets that were acquired, like Tucker, ironically from Cenovus as well. And they're basically adding them on, saying in aggregate, 129,000 barrels per day were produced from those assets. So Serafina, Tucker, Caltex, Awesome, Pengrowth, and Kona. 129,000 barrels were acquired, but now in Lloydminster segment and Coal Lake segment, we have 109. So then the angle here is like, okay, well, how are you gonna like optimize us or grow production? Where is the track record? Like 16% decrease from what was acquired. Now, I don't know if it's true or not. I didn't do my homework. I'm just talking to the slide from the public domain, but basically you can see how the board is positioned here from analyzing what took place, and seems like they were doing their due diligence on understanding. And historical organic growth was in the Montney business, right? So the Montney business, by the way, was divested. We saw 3 big transactions. The 2 bigger ones were between Strathcona and Tourmaline, and Strathcona and Arc Resources. And in my view, it was pretty well done by Strathcona. But in overall, they grew that production to about 25,000 BOEs per day. So, and they divested the business that it had been successfully growing. So there lots of credit is given towards that business that no longer exists, and leaving it with heavy oil business, which has shrunk over time. So they're basically trying to compare apples to apples when it comes to their business and what it means for their basically growth trajectory. So now they're showcasing due diligence when it comes to better understanding Strathcona's SORs since acquisition. And again, you will never hear it on Twitter. On X, nobody cares, because when things become a little bit more technical, there's no interest. It doesn't matter, right? But as you look forward, there is this concept of geology that I'm talking about. And for those on, I have the little model here that I like to show here. For those that watching on YouTube, so what you have here is injector well, production well, and chamber development, steam chamber development. And you could have like an infill here on the side that collects the oil that's being drained by gravity because of the heat transfer from the well pairs in SAGD, from the injector and producer. And what they're suggesting here is that the geology here is very different between the two companies. They have very homogeneous reservoirs with very low SOR, and these assets have maybe higher heterogeneity, so higher SOR. And they directly talk to each asset and trying to basically say, hey, look, we're not even close to being twins, we're very different. Again, some of the language here is a little bit kind of direct, not very comfortable with that, but it is what it is. But what they're saying here is that MEG annual SOR has exhibited superior levels of tighter range since 2018, which is true, right? So they've been around SOR 2 to 2.5. And since acquisition, but talking about other assets, so Lindbergh, Orion, Tucker, Edom, and Meoda. So Meoda will be the kind of Saskatchewan regions, Edom, Saskatchewan, Tucker more, I think, in Alberta, Orion, Alberta, and Lindbergh, Alberta. Tucker was acquired from Cenovus. And they're basically suggesting here that, hey, look, SOR is actually for Orion, Tucker is increasing in aggregate, and for Edom is okay, it's kind of declining. So they're being fair, right? And for Meoda is increasing. Now, again, I don't want to say I know that it's true, even though I did my own work and I have the numbers when it comes to kind of their monthly SORs for those assets, because I don't know anybody else that monitors them as much as I do. So I have really good understanding of Tucker, Ryan, Lindbergh, Edom, Meoda. You can look at my YouTube channel. In my videos, I cover, in fact, some of those assets. I cover in detail the Orion asset because I had a team where I mentor at Southern Alberta Institute of Technology, SAIT. I have a group of students I mentor, and they were doing a project on Orion. And so to kind of give them baseline and educate them on the asset, I did a lot of my own due diligence. I volunteer and help students in that way. And we did see kind of similar SORs, right? But seems like MEG really diving in here from a technical perspective and saying, hey, look, this is kind of what changed from acquisition, and that's why you're not like us, right? So they're talking about degraded performance from initial acquisition across the in-situ portfolio, recent successes at Tucker, follow 3 years of weak performance following initial acquisition. To be fair, I think they kind of did a good job there, Strathcona did, because they got an asset that was kind of declining, but they did optimize production and they kind of did their best there. So I think it was well done. Contrast with MEG, a superb track record as an in-situ operator. So that's kind of the context there. Okay, so here they talk about specifically about, do we have any questions online or any comments, anything you guys observed so far? Let's maybe give some people some opportunity. We've kind of been 40 minutes into this, so let's see what people think. Maybe a good opportunity to share the disclosure here that not investment advice, but trying to kind of educate myself and others about what's been going on here. Okay, so here they talk a little bit more nuanced about water energy fund and kind of the share price of the combined company will face significant pressure in depth of WFLPs sell for liquidity. So I don't know, basically this is more kind of dynamics when it comes to the positioning and the magnitude of the positioning. They talk about that major shareholders have not been able to sell today due to poor trading liquidity. We know from the past that people talk about that, but here they basically express their concerns when it comes to liquidity. They talk about risk to shareholders. And I think majority of the risk is really what they describe here is in the concentration position. But a lot, to be fair to Strathcona, a lot of the views on X were kind of like, hey, this is our liquidity is being added to the liquidity of your liquidity. So we're not going to be trading less because, of that situation. So combined, we're going to be better. But as you can see in the slide, MEG is kind of not very happy about that liquidity. Also, there's kind of this fear that some people will be selling or some traders will be selling and kind of gone. So they encourage people to consider, potential negative impacts. As you can see here, incentives are not necessarily aligned with other shareholders, could exert downward pressure of the trading price. Here we have a comment. Very much appreciated detail you're going into. Thank you. Yeah, Steve, thanks so much. I think the idea here is not really promote one side or another. It's more maybe to force myself to read the slide deck in detail and let other people challenge what's being shared and maybe talk about how they see things. And we're going to be fair to Strathcona and share their slide deck in response. But I think you can start kind of seeing the theme here that we have two different assets, two different companies that being kind of compared as twins. And MEG is saying, wait a second, we're not twins at all. And those are the reasons why we're not twins. And many people were saying, look, the board is kind of, because of their rewards through preferred share units, PSUs, they have this kind of incentive. But I choose to kind of be a little bit naive about this, I guess, and say, look, I think they're doing a pretty decent job here talking about the actual points, especially in this table, talking about assets, talking about valuations, unique risks, ownership. So I think there's some, something at least to consider for people, as part of this. Okay, so let's, do we have any other comments there? Sorry, 1 second, guys. All right, moving on. Any other comments? Tracy, do you have anything from your side? What do you think so far? I think it's a very intriguing situation, but in overall, I think it's really positive for the sector, right? It's really good for the sector that it's happening because it attracts more attention to other companies, and there's kind of this bidding war, but in a way, it's not. It's more kind of like they're trying to address who is the best fit for the company. There was the suggestion that the stock should be going to like $42 because Cenovus shares were appreciated by a certain amount. I think it was like 4 billion, and so that should have been kind of like part of a MEG's benefit. I don't know if I really understand that angle, to be honest, because companies, if you have undervalued paper relatively to others, which seems to be like the core assumption here, I don't know how you can kind of suggest it's a valid, allocation of funds. Okay, well, let's keep going. No further comments, so we're good. So the Strathcona is adding 43% liquidity after the deal. Okay, let's read this comment. Strathcona is adding 43% liquidity after the deal. That gives MEG shareholders 43% of Strathcona. MEG shareholders will only hold about 3.6% of CVE post-merger. That's a fair comment. PJ, I think the one of the issues here, what they're talking about, because we're trying to kind of see things from their perspective too, right? So I hear you, and I think that's what they basically talk about here in this slide. So they say 27% of consideration of the shares, the rest is in cash, but here 100% of the shares for the revised offer. But for me, I think what they're kind of worried about is that implied NAV upside. Would you agree with that? Because they talk about, hey, this paper looks overvalued. This paper seems undervalued. We going from point A to point B. Point A kind of gives us that, that more benefit to shareholders. Drunk says, does the fact that CVE has over 1.8 billion shares outstanding be a negative compared to Strathcona having around 200 million shares outstanding? Well, that's I think what they're talking about here. They're talking about liquidity, right? And who owns it. In this table, you can see who is the major shareholders for Cenovus. They talk about long-term investors since 1986, major shareholders, kind of institutions, participants, right? Here they talk about some interests. So I don't know if it's entirely true, but that's kind of their fear here about not just the shares, but who owns the shares. Okay, so let's talk about this slide now. MEG shareholders recognize the risk associated with the revised Strathcona offer. We can see a chart here that talks about the MEG share price relative to headline price of Strathcona proposal. So here's so that's kind of one of those unique angles that I think it's really important to consider, right? Because there was this assumption, like when it seems like when Cenovus made their offer, their stock jumped too. And I'm maybe getting a little bit repetitive, but there was this kind of assumption, hey, your stock jumped, so that value should have been allocated to MEG. But what we see from this chart is that once Strathcona approached MEG, the headline price of revised Strathcona offer also jumped, right? So kind of they say, hey, we need to consider the headline price of initial Strathcona offer per MEG share, so that ratio, and what does that look like? And under core assumption that they assume that the paper could be overvalued as of now. So that's kind of what they're saying here. So MEG share price has exhibited little change in response to revised Strathcona offer, indicating that the market agrees to lacks credibility. It lacks credibility. Again, very strong language. Market is heavily discounting the value of the revised Strathcona offer. Market recognizes that the headline price of the revised Strathcona offer is not reflective of true value. An overwhelmingly acknowledgement from MEG shareholders on the industrial logic of the Cenovus transaction. So majority of MEG institutional shareholders have expressed strong aversion to receiving Strathcona shares. Now, on X, we hear things are a little bit different. Basically, people saying, no, nobody wants that transaction. We don't know if it's true or not, right? We just see what's on the slide in the public domain and what's being shared. It's very difficult to say, but we do know that Strathcona did their very best to acquire as many shares as possible from MEG. I think it's at about 14.2% right now. And so they basically going to recommend no to the Cenovus deal. I think it's a very important slide just from their side point of view of how they think about this. Okay, so let's talk about the Cenovus offer, because the other angle that we don't see on X a lot is kind of like, okay, Strathcona offers 11% or whatever, 12% more in the revised offer, but let's see what the board here thinks about the clear benefits, because it's not very clear to most participants, right? So let's see from their angle. And again, we're going to be fair to Strathcona and going to show their slides as well. But what are they thinking when it comes to short and long-term value creation potential for MEG shareholders when it comes to the Cenovus benefits? So they say here 38% premium to unaffected 20-day VWAP price. So I assume I can't really see what it says there, but it's probably some moving average or something. And currently 28% purchase price per MEG share. Value of consideration is highly certain, cash and highly liquid share consideration, 73% of consideration in the form of cash and remaining 27% in Cenovus shares. So again, they express some of their concerns associated with what could happen to the shares after the transaction. Participation in Cenovus has identified significant synergies. Guys, like, let's be honest about this. Like, I think there's very little doubt that you basically geographically like linked, right? You next door to each other, so you could be developing. And again, we talked about the steam allocation for certain reservoirs and the heterogeneity involved. So again, if you look at my model here, you can have steam chambers right now, or chambers that are going to be developed in the future that have a lot of heterogeneity here. Maybe clays, maybe non-permeable barriers, maybe low permeability, maybe lower porosity. The bigger acreage allows development of better reservoirs with the process facilities that come from MEG to be allocated strategically across the asset, right? And we know in this region, maybe companies that drill their best acreage first. So now you're basically tapping into more as you reduce the SOR and better utilization. And now because of the slide deck, we learned actually that maybe the growth is going to be a little bit even more from what was initially designed to be at 135,000 barrels per day. So we're not going to just 135, we're going to 150, because it seems like Cenovus could be supporting that growth from the central process facilities. Now, that makes a lot of sense to me personally, because you are able to do a lot more with those facilities as you exploit the asset, right? Because I think there's something like 50 years of reserves, about 4 billion barrels in situ for the overall region. but from what's being currently exploited is about 2 billion, I think. And the current pads, so pads will be basically clusters of those well pairs that I'm talking about, all those big well pairs. I think it's 0.8 billion in oil in place. So just something to consider, that the combined entity could kind of do maybe a better job cutting costs, but also spending less money on better reservoirs, improving the type curve, and uplifting production relatively to like standalone entity. Okay, we have a comment here. I'm voting for no deal for either offer. I have a cost basis of $8 USD in MEG, do not want to pay capital gains. Fair enough. I think, Kev, the company was put in play, and my understanding based on kind of observation is that they wanted nothing to do with getting acquired. Now, one cannot, kind of deny the fact that the shares jumped significantly since they got the offer, right? And a lot of the fear from market participants is that the share is going to go back to what they were prior to the offer if there is no transaction. But we know there will be a transaction because one way or another, there's already board is kind of committed, and we know that there will be a break fee. But we do have Strathcona in the middle now, basically trying to block the deal from happening with Cenovus. We will see if they're successful. But I hear you. Like M&As are tricky that way, especially from tax considerations. One thing I will tell you is that I actually went to the podcast In the Money in person in Calgary. And the first thing I did is I shook Adam Waterous' hand out of respect. I went to the guy and I shook his hand. I shook the hands of his team members out of respect. I think he plays an important role in our sector because there's nobody like him and his team that does what they do. And I think in overall it's good for the sector because for years we've been talking about generalists coming and, but here you have an entity that realizes the value of these assets, and all kind of boats are getting lifted in a sense when it comes to recognition of value. Now, I don't think we're going back if no transaction is made, but it seems to me like, and we're going to learn soon from their slides, to be fair to Strathcona, what are some of the incentives from their side to do this deal, right? So I think it's kind of important to consider both things. So yeah, but I hear you when it comes to capital gains. I mean, if you paid very little for the shares, if you bought in like 2021, 2022, you up 200, 300%, and now you have the situation. It's very unique where here you can just take the shares and just keep snowballing, I guess, from a value perspective. But here maybe you will be given cash back, and now it's kind of a taxable event. Not sure. Sounds like you're American, so I don't know much maybe about those transactions. One thing I would add is that what's really kind of interesting about the second offer they made is that it was all stock deal, and then the special dividend all of a sudden became not a dividend. It was also seen as return of capital. And when I listened to the podcast the first time, I was like, well, that doesn't make much sense for American investors. And sounds like, Kev, you're in that camp, right? Like if you get a huge dividend and now you have to pay a bunch of taxes on that, where return of capital, in my understanding, has a different tax structure, more kind of friendly to shareholders. So they had to go back and revisit their $10 per share dividend or whatever they declared initially, if the transaction was not to take place. Now my understanding is about $5. We're going to be soon seeing their slides. But, it's a very dynamic, fluid situation, and things kind of evolve as we go here. Okay, we have another comment here. Isn't the Strathcona offer all tax-free since it's all shares plus a return of capital? Well, there will be a special dividend and then return of capital, or it depends on, I think my understanding is that they can choose. but I'm not sure exactly. Oil investor. I'm not a tax expert. I have no idea how the tax treatment is when it comes to M&A, especially in our sector where we haven't seen much of that, especially in the names I'm in. So I don't know. I'm more of a technical guy. You will see me talk more about SORs and geology and the kind of central process facilities, and I kind of see things more from that angle, but not sure about the tax benefits. But thank you for your comment. By the way, to those that listening to us on X, Twitter, I'm live on YouTube showing the slide deck. Those things are not just coming out of my head. I'm really talking to the slides in the public domain, trying to educate myself and sharing with the community kind of what we're seeing and some of the thoughts about the angle. One thing I think we're learning here for sure is that there's this kind of understanding on X is that the MEG board is not maybe acting on behalf of the shareholders and the benefits of the shareholders, or doesn't know what they're doing. My interpretation based on what I'm seeing here is that know exactly what they're doing. This seems like very smart, intelligent people that have some points that one needs to consider. And it seems like based on their assumptions that they do act in kind of their best interest of the shareholders, at least from the slide decks of what they're saying. I don't think it's as extreme as some people suggest, that maybe they don't act in the best interest of the shareholders. Okay, so robust strategic review process delivering premium value. Again, they followed through with this strategic review. Just a quick reminder, once the offer was made, so it was $21, it went to 25. Then there were like 2 improvements to Cenovus proposal. Stock went to 27. Clearly superior proposal based on what they say to 28. Now we're closer to 29. I'm not actually sure how the stock is trading now, like based on which offer, but they're basically saying, look, we went through a comprehensive publicly announced strategic review, right? 15 parties contacted. Now, this is very, very important. I really want to talk about this because I hear a lot of fake news about this from different like experts online, ex-experts saying, look, nobody, initially we heard, hey, nobody is coming for MEG. Nobody is going to make an offer. There's one entity interested, nobody else is coming. Okay, well, I guess people came. The other angle is like, okay, well, nobody else made offers. Nobody else cared. What about 15 parties contacted, which is what is being publicly disclosed here? What about some companies deciding not to pursue the deal, or maybe some companies didn't want to overpay? Maybe some companies, and I think Rich Kruger alluded to that in Suncor's quarterly earnings. He said, look, we looked at our brownfield expansion plans, and it's about 20,000, 25,000 per flowing. Why would we go now and pay 80,000 per flowing? Like, it doesn't make sense to us, right? Like, why would we do that? He didn't say it directly, but if you read between the lines, you can kind of conclude that. And, I'm not blaming him for thinking that way, but it doesn't mean the entity is not interested. In fact, I remember a couple of years ago when Total was exiting Canada SAGD business and mining business, Total, right? Total Energies, the French company. There was 50% stake in Surmount that was kind of, and Rich Kruger joined Suncor, and within like a week or two, something like that, they made an offer on that asset. And that asset was trading, I think, at about 60,000 per flowing. So we have a good range here. We have a good understanding. Hey, 80,000 per flowing for those type of assets, it's kind of where MEG is at, maybe a little bit more and maybe a little bit less. But 60,000 per flowing is very cheap because your development is maybe 20, 30, 40,000 per flowing. So now you can maybe arbitrage that. So we know this is doable. But when 15 parties contacting and interested to learn about the situation, and we have one company that really interested because of their synergies, like, what's wrong with that? Maybe other companies were like 5,000 per flowing off from their target, and we're kind of like, I think our chances are kind of low, so why to even enter that fiasco, right? Why to even bother, right? So people don't think about that. People just kind of like, no, nobody cares, nobody is interested, which I refuse to believe. But and by the way, we don't know if we have a third entity coming soon. We don't know. It's still very much unknown, because we do know that the strategic review took place, and we do know there's an offer. But maybe the strategy for other companies is kind of like, oh, let's see what chicken bake here, what's unfolding. Maybe we're kind of gonna, join the process as we go, right? Like as we see an offer, and maybe there's some time frame. Like, I personally don't know those type of rules, but it could be a scenario. So basically, and guys, I don't think it's common knowledge. I don't think people know that 15 parties contacted MEG and were interested in the process and understanding, right, of what's going on. So they went through a thorough assessment of broad range of potential alternatives, including the initial Strathcona offer, robust outreach process. So 15 companies. I mean, probably all the usual suspects were there, right? I mean, Canadian, US, international parties were also coming in. How many people know that? How many people know that US international companies were also in the data room looking at this data? 15 parties, guys. So all parties had the opportunity to participate. Strathcona declined to sign a standstill agreement. 3 proposals received 3 proposals, including initial proposal from Cenovus. Cenovus' initial proposal was 25 per meg share. How many people know that? Consideration comprised of 80% cash and 20% Cenovus shares. Sorry, guys, I'm kind of choking. I've been talking for like an hour. All right, so then we have 2 improvements to the Cenovus proposal. Again, within the review, strategic review, we have activity there. Thorough negotiations, where Cenovus amended its proposal twice. Interesting. 9% increase to value to 27.25, increased the proportion of share consideration to 25%. Amended Cenovus proposal recommended by MEG board, presented to MEG shareholders on August 22nd. Public announcement. Okay, so we see some level of due diligence here, right? Public announcement, announced Cenovus transaction is the best strategic alternative for MEG, reaffirming recommendations to vote for the Cenovus transaction following evaluation of the revised Strathcona offer, $28, so we're not far away from there. So again, for people that saying, hey, those guys don't know what they're doing, well, they're showcasing here, they're displaying a certain level of process that took place, consideration, all those things. Okay, let's see some of the comments. So the first comment was, it just lowers your cost average when you sell. So I guess this is for the oil investor. Isn't the Strathcona offer all tax-free, since it's all shares plus the return of capital? So now we have PJ saying, it just lowers your cost average when you sell. Then we have a comment, you defer any tax payment as long as you hold. Drunk, the CVE is the one you can choose which option you want. Okay. Okay, thank you guys for the comments. Okay, so we are now on slide 12. So before we proceed to slide 12, I'm gonna take a quick break here, maybe a couple of minutes, and then we can kind of get back and cover a little bit more. Gonna grab some more water, encourage you guys maybe do the same, and then we're gonna continue going over the slide deck, and we're gonna review the Strathcona presentation there. By the way, if you guys interested in joining the live chat, I see some friends here in the chat room, and discuss live, I can send you a link to my YouTube discussion, and you can join as a person to the discussion. But I will not join, like I will not let you join if I don't know you, because I don't want like any displays of inappropriate things, you know. So this could happen. But if I know you and you want to join the chat and talk about the slides, then you're very welcome to join me. Yeah, and again, we're talking, this is not me showing up and complaining about something or being happy or unhappy. We open the PDFs for MEG and Strathcona, and we talk to the slides. And people in the community make comments, on YouTube. We display those comments. We talk about them for advanced education about what's happening here. And again, my view is that this is really good for the sector. This is really good for the sector because I think it kind of brings more interest to our sector. Okay, 1 minute break and then we continue. Okay, thanks for your patience. I'm back. Can you guys hear me okay on the YouTube live stream? Is that okay? Sorry, I kind of muted my mic there. Do we have any more thoughts, comments? What do you guys think so far? Let's see what people say on Twitter first. I understand your point of view that this is really good for the sector, but the only thing that should be matter is what's best for the MEG shareholders. No, that's fair, Phil. I hear you. Yeah, I think this was more of a kind of general comment. And what's good for the MEG shareholders is kind of interesting here because based on this slide deck, we can see there are a lot of assumptions that are being made from a forward-looking perspective, right? Bill, we don't see many people on Twitter, on X, talk about that angle. That's why I think it's really important to kind of pause and say, okay, how are these guys really thinking about this transaction, right? Because here clearly there is a premium that's being promoted. So how can they walk away from the premium? But what they're saying here, and we're going back to slide 3, they're saying, hey, this paper is 20% undervalued, and this other paper is 30% overvalued. So that's their core assumption. And then they basically take the brokers and say, look, this is 100% highest among peers for buy recommendations, and the other guys are 20%. So this is their core assumption. So some people say, well, they don't behave properly on the behalf of the shareholders or whatever. Well, this is their kind of angle here. And I think it's important to understand how they think about this. I don't make the rules, I don't know. like everyone else, I'm guesstimating what's fair, what's valuable. But if they're right about this, then those shares decline by 30%, those shares go up 20%. That changes the equation a little bit, right? So, but I don't know if it's going to happen. Like nobody knows, right? You guys agree? You think it's reasonable? Okay, so in this slide 12, they talk about the Cenovus transaction that delivers a certain outcome. They say it's a strong outcome. Their metrics are attractive in the context of the market. Now, we've been hearing a lot of people talking about how Cenovus is more undervalued. And the angle there was kind of like the refining angle, is that the refining business been having issues, which is true. I think like from the quarterly earnings, we've been looking at some numbers there with some friends. And the business, it's not a bad business, but it's kind of breaking even, right? So from investment point of view, you're thinking, okay, well, you're refining those products, you're dealing with significant capex allocation, everybody's getting paid, employees getting paid, and then you break even, right? Or maybe I'm not being fair, maybe you generate like 1% cash flow or free cash or 2%. But investors are looking for higher yield, right? For higher return. So what was interesting that took place is that they did divest big portion of their refining assets now with the Phillips 66 transaction, and that created more opportunity for that. I think it was 1.9 billion to be deployed for other purposes, and kind of remove that additional, I guess, fear from people saying, well, you're going to be dealing with those downstream issues for the rest of your existence, right? So, which is another interesting angle here. Okay, so they're looking at highest flowing barrel multiple for oil sands transaction in the last 10 years. So they're basically saying $75 per flowing. Pure play oil sands transaction since 2015. Okay. Basically suggesting they should be acquired, I guess, for that reason. So they're saying 75. I'm thinking it's more closer to 80 right now. But again, how do you, and that's one of my challenges, and I'll be very open about this, is like, if you think about, let's say, companies like Athabasca, right? So you produce 28,000 from Lismer, you'll produce, let's say, 9,000 from Hanging Stone, maybe another 4,000 or 5,000 from Duvernay Kaybob. So let's say 40,000. And then with your growth for an asset like Lismer, you're going to grow by 12,000 barrels a day. And for Hanging Stone, you put a couple of infills, and now you flush production. You're producing maybe 10,000 barrels per day, which they can. The CPF can support that. So your trajectory with Duvernay, especially, is kind of like you could go to 60,000 barrels per day in a couple of years. So assuming markets are forward-looking, at which point do you allocate that multiple of that per flowing metric? Same goes to like NAV multiple or cash flow multiple. Like at which point do you assign that? Is it today? Is it in a year? Is it when they do that? Because markets will quickly catch up with the value proposition, right? Because if you trade, let's say, today at 40,000 per flowing for those type of assets, you're probably getting acquired right away for a very high multiple premium. But if you trade closer to 80,000, then maybe the premium may not be as high, right? So personally, that's kind of my challenge. They talk about premium transaction multiple, so 7.5 times multiple. Oil sands median is about 6, and top quartile share price premium, transaction premium, 33% premium to the announcement, ranks above 80th percentile of premium paid in Canada. So I guess they're trying to justify here why it's okay for them to get acquired following the strategic review process, right? Where we hear a lot of voices, people saying, hey, you could have been better staying by yourself. You didn't need to get acquired, which I kind of agree with. But they were put in place, so it is what it is. So key takeaways from that presentation. Cenovus transaction offers superior value based on what they're saying. $28 purchase price represents 38% premium. We talked about the baseline. They assumed high degree of value certainty with consideration in the form of cash and high liquid Cenovus shares, especially with that money coming in from refineries now. Upside participation. Again, we talked in detail about this, how the asset could be developed further in the broader Christina Lake region, expanding Narrows Lake there, north to the lake. Industry-leading producer with significant scale and growth potential. So over 400 million in annual synergies identified. I think it's 2028 timeframe. Accelerate value realization from MEG's standalone plan. Again, I think we talked about this in detail, but the angle there is that instead of going to 135,000 for the central process facilities, they're going to be going to 150,000. Again, I think this is the value of this talk, is that I review those slides. I'm forced to look into those words, understand what they mean, communicate with the community, get feedback, hear from you guys what you think from the YouTube live there, and get your kind of maybe there's like different observations you're seeing from that. So unanimously approved by MEG board and expected to close early in fourth quarter 2025. That's basically where the delisting of MEG going to happen, considering they get acquired by Cenovus, and that's obviously going to be contingent of the vote approval from I think it's over 66% of the shareholders, and so they basically saying vote for the Cenovus transaction. Now they comment here on the revised Strathcona offer provides unattractive share consideration. So they say a revised Strathcona offer fails to resolve the adequately compensate for the significant risks. Sorry, I've been talking too much, guys. It's 1 hour, 20 minutes of me just talking. Compensate for the significant risks identified in the MEG board initial rejection. We did see a lot of those parameters, liquidity, they suggest overvalued paper, inferior assets, things like that. And here they say it again. They think Strathcona shares overvalued. Again, guys, not comfortable even saying that. I'm looking at the slide deck and just saying what they say here. I don't know if it's overvalued or undervalued, but that's they directly basically head on saying, hey, we think you're overvalued. I think the true value, and I shared this already, is that we never see companies talking about other companies like that, right? It's a very unique situation. And I think it's really important to talk about this and cover how everybody thinks about everybody from that perspective, especially through those transactions. A significant WEF overhang risk. So they don't want that LP kind of exposure. Selling to date is only a fraction of what will likely come. They think there will be more selling, considering higher liquidity, I guess. I don't really know how to think about this. I've never seen a scenario like this. I would love for people that watching this to comment on YouTube there, where we show the slides, and really try to understand, is this a risk, this overhang risk, or it's imaginary risk? Nevertheless, it comes from the board, so they think it is. My biggest issue is MEG shows all the joint benefits of combined company. If offer was in all shares, not most cash, then the future growth and synergies would be relevant. BOD agreeing to buy out. I understand, PJ. Thank you. So I guess getting cash creates more flexibility, in my understanding, right? More certainty, more optionality. So there are a couple of sides to it. Depends on if you just want to take shares, maybe buy something totally unrelated to this. But if you want this thing to be rolled over into, 27% Cenovus or 100% Strathcona, this could be a tax kind of benefit, right? But each case is unique from that perspective. Prevent shareholders from capitalizing on the upside that will happen in the entire sector. That's your comment. Thank you. So MEG board has reaffirmed its recommendation to reject the revised Strathcona offer. Now, on X, on Twitter, in our community, broader community, it was a big shock. People did not expect this to happen. They were like, oh, what the hell, dude? These guys gave us like 11% premium even now, and you reject even this. We're giving you so much more now, and you have the guts to even reject even this. That's why you have to be biased. So from my perspective, I don't know. I think there is an opportunity here for a little bit of a pushback, because what these slides are saying is like, look, there's a thought process here on behalf of these people from MEG's board. They think in a certain way, they make certain assumptions, and they communicated those assumptions. For me, as the presenter of the slides, at times I was very uncomfortable even talking about some of those comments. We're going to be soon seeing what Strathcona is saying. But it is what it is, I guess, right? Okay, so advisories, forward-looking, continued information. So these are the MEG slides, friends. So now I'm sharing my disclosure again. Like I shared, please pause the video and take a look again. This is not, this is information, public domain, opinions, not for investment purposes at all, not an investment advisor. We're a community talking about publicly available slides, and we're discussing those slides. We're forcing ourselves to learn about those slides, to discuss them, to better understand what's going on here. What's the thought process in this, kind of like a very intriguing situation, because we have an entity that really wants MEG. Strathcona really wants MEG. They came back the second time, and they were rejected the second time, despite their attempt to sweeten the deal. And these guys choose to go with Cenovus again. So we must explore why this is happening and understand all sides of this transaction, not to get emotional about it, but mostly understand how are these guys thinking, how are those guys thinking. Okay, we have a comment here. Thank you, Robert. On the acquisition, I think there will be a devaluing of the value of the shares that you acquire unless there is a clear added value of MEG assets to either CBE or SCR. When Enerplus was acquired by Cord, we saw the Cord shares decline in value. When SDE, so Spartan Delta, split into new SDE and LGN, we saw the post-split shares also decline in value. So very good comments. Thank you, Robert. Okay, let's see if we have further comments from Twitter, from X. So John is saying, what if you took the cash portion and reinvest into Cenovus so that the MEG shareholder, we can capture all gains? Yeah, John, you can do whatever you want, right? There's clear kind of assumptions here in MEG's presentation that we looked at, where they talk about, so let's go to slide, I think it was slide 3. They talk about by how much CVE shares are undervalued. So if you take them for their word, based on their assumptions, you could maybe capture that 20% as of, but then again, a lot of assumptions here. September 15 slide deck, there's a price. What does it exactly mean? Then, the transaction is happening if it's approved in Q4. So, so yeah, you can do whatever you want. It gives you that option. In the Strathcona case, you can't do that. You have to take the shares as part of that. If it was to be approved, right, one day, but we don't know if it's going to happen. Okay, so I want to talk about Strathcona now, showcase the other side of this. To be fair, and again, I think it's good for the sector. I have a lot of respect to Strathcona management, to Waterous Energy Fund. Really, really impressed by their ability to recognize value. In a way, I'm thinking, wow, if I'm Adam, I'm kind of doing the same what he's doing. Maybe like, I wouldn't know how to do hostile takeovers, right? Maybe it's kind of, you need to be way more experienced and have that knowledge of the strategy, but I do see the same value as he saw, right? And I did see some of his presentations when it comes to, he talked to students about how to capture value from low declining assets, how to better understand kind of like cash flows, taking little risk with established assets that have very high oil in place, very predictable recovery schemes, de-risked when it comes to operations. I very much connect to that. So I understand why they're doing what they're doing. But obviously there are other reasons, and we need to look into those reasons. So this presentation is from today. It's from today, September 16th, and they call it fact versus fiction. And again, we see a very kind of colliding language, right? These two companies are not nice to each other. They're not nice to each other. MEG is kind of pushing back, saying, "Hey, why are you even going after us? Look at all the reasons." Strathcona is pushing back and saying, "Hey, fact versus fiction. The sequel. We have more to say about this." So, and I think it's important to display both cases, forcing myself to read those slides, share with the community, and see what you guys have to say. Okay, we have a comment here. Aspilaga Victor. Thanks for the video. I'm learning a lot. I think the premium of Strathcona is board aligned with shareholders. A very active board, by the way. They are acquirers. Thank you. Continuing with the comment here, I think if Waters gets MEG with investment grade, there will be more acquisitions and more growth. So I really agree with that comment. I really agree with that comment. By the way, guys, I'm reading, for those on X, I'm reading this from YouTube Live. So we have a community here of people participating, engaging. They're sharing comments or their thoughts about the slide deck. We're talking about publicly available information, but trying to better understand the slides and what's happening here. We did learn a couple of key things from MEG slides. The first thing we learned is that they're going to grow to 150,000 barrels per day on their central process facilities, which is huge. The second thing we learned, which was really, really eye-opening, what was that one thing that I learned? Oh yeah, so they kind of did a good job capturing kind of the price action for the headline price of the initial Strathcona offer, and kind of capturing the price fluctuation over the course of time, saying, "Hey, wait a second, that 0.8%, that 0.8% per share or whatever is kind of like really undervalues our shares." Was there something else? I think one of the biggest takeaways here is that they really anchor themselves to saying, look, we're about our assets. We're not Williams by any means. But what's even more important is that brokers, they think that your paper is overvalued and Cenovus paper is undervalued. And we forward-looking, trying to add value to our shareholders. So that's the one thing I learned here as well that I think is very valuable. Okay, another comment here from Jack. I don't know why Cenovus doesn't substantially raise its offer to effectively eliminate Strathcona bid. Cenovus can always sell at their downstream assets. Long-term 500 million difference doesn't mean much. Thank you, Jack, for this comment. I've heard a lot of those comments, like why they don't pay more. And I can kind of maybe share my views about this. As a company that's been seen very undervalued for a very long time, in my view, they had one job and one job only, in my view. And that job was not to overpay or not to look like they're overpaying. That was their job. When the market recognized that management is able to make good decisions and not overpay, they immediately got rewarded. You have to look back a couple of years to understand exactly how the market values this company and the downstream kind of challenges they've had. Disappointed investors, people on BNN, market call complaining, right? It's not easy. I understand that angle. But they almost had to show the market is like, hey, wait a second, we're making good decisions. We're not overpaying for assets. We're able to transact and make things accretive for us. So I hear what you're saying here. Yet the CEO, John McKenzie, said, we're closing the door on additional bidding scenarios. Jack, to be honest, I don't know if that's a strategy they're implementing. I mean, obviously, as we see those two entities collide here through those slide decks, and we see that unfolding in front of our eyes, there's also a game that's being played by the third party, right? But I'm not smart enough to tell you that they kind of do this intentionally and then they're going to maybe increase their bid, or but they're being a little bit passive now, and I don't know if it's good or bad. I think it's maybe okay because the price is not increasing or we don't see more aggressive actions. We did see Strathcona increasing their ownership of MEG to 14.2% of the overall shares to vote against the transaction with Cenovus. So we did see that, but maybe they believe they have enough votes to just transact. And clearly, board for MEG is okay with the deal. So why do they have to increase? I mean, they don't have to, and even if they had to, then maybe they would have, but they don't have to do anything. So maybe it's part of their strategy. Hopefully you guys learning as much as I do by reviewing the slides in detail. So Steve says it would be fantastic to know what Adam's previous dealings when he was a banker with MEG were. I suspect there may have been friction. It's interesting you say that. I don't know what the dealings were between him and MEG. I actually didn't even know him or that entity. By the way, I don't know if too many people in the sector actually knew Strathcona that well. Not too many people knew Serafina well, but Strathcona is kind of the new entity. People for sure know Cenovus, MEG, right? Really kind of old-standing companies. But one thing I can tell you, you have a very interesting angle here, but not because of Adam dealings. It's because of the management of Cenovus. Because as you know, Husky merged with Cenovus, right? During COVID. And my understanding is that John McKenzie, the CEO of Cenovus, used to be at Husky at their leadership there. And we know that Husky made a bid on MEG. So in other alternative universe, this could have been about one guy pursuing MEG over the course of 8 years and now possibly getting them. But we never hear that side of the story, the John McKenzie side of the story. We never hear that side. By the way, I'm not qualified or knowledgeable enough to share exactly what took place there. I don't know. But I have high confidence that he was in the executive team for Husky when they tried to acquire MEG. I think back then it was for $11 per share. I think the enterprise value was close to $6 billion, something like that. But thank you, Steve, for this comment. Another comment from Robert. If I were MEG and as a MEG shareholder, I would be or am insulted that Waterous came with a low bid to undervalue the MEG operation and assets. This may have created a low benchmark for any future bids. Robert, it's interesting you say that. It's interesting. At the same time, this slide from MEG here, it's an interesting one because it kind of talks about the strong value that the Cenovus transaction delivers. Now, we know for a fact that the price is about $29, right, from both sides. And now with the premium, as they compare it, and let's be exact, let's not speculate. We have a slide on that as well, where they say it's going to be closer to 30 per share, right? So yeah, $29.98 for the Strathcona revised offer, and about $28 for Cenovus. What's interesting here is that they talk about that the Cenovus transaction matrix are attractive in the context of the market, where the highest oil sands transaction multiple at 75,000 per flowing, they see it as reasonable. There's no denying that. This is the slide. This is what it says here. So I have to take it for what it is. There are small letters there, so there are some key assumptions, which I understand, will provide more assumptions from the context of what they assumed for that transaction multiple to be as fair. But we have to give credit to Strathcona from that perspective where, I mean, they did set this kind of level not to overpay. These guys followed up with not overpaying. Nobody's trying to overpay, but everybody wants MEG, right? So that's kind of the game here, right? That's what makes it intriguing, I think. I hope you agree with me. So I'm trying to be a little bit fair to Strathcona as well, to be honest. Okay, anyway. Fact versus fiction, the sequel. All right. So how did we get here? The MEG board deal is the result of broken strategic review process that excluded Strathcona and thereby diffused all competitive tension, preventing value maximization for MEG shareholders. So that's the other side of the story. Fact, MEG ran a broken process and agreed to a deal that forces shareholder to exit at an unattractive price. Strathcona initially proposed a combination with MEG on April 28, after discussing the concept informally with a MEG board member on April 10th. So now we know they pursued them before, 18 days before they made the offer. On May 13th, the MEG board responded with a 3-sentence email, including MEG was not interested in a transaction. That's, I don't know, guys, it's pretty funny, right? So May 13th, they're like, 3-sentence email, not interested. I don't know what the other sentences were, but this remains the only dialogue the MEG board has had with Strathcona in 4.5 months. Now, here's some of the discussions that we were having on X and within the community trying to understand the dynamic here. Everybody were invited for the strategic review process. So let's go back to the MEG slides here and what they're saying about the strategic review process. They say it was very robust. They say the thorough and comprehensive publicly announced strategic review was conducted with 15 parties contacted and 3 proposals that were received. Now we learned, and that's another thing we learned from the slides, that Cenovus' initial proposal was $25 per share. So they actually made an offer in the data room, and then they revised that offer to $27.25, and we have basically 3 proposals that were received. They also say from their side is that all parties had the opportunity to participate. I assume they talk about Strathcona as well, and they say that Strathcona declined to sign a standstill agreement. Okay, so what we're reading from this is that Strathcona says, look, they sent us this like weird email on May 13th, 3 sentences, said we're not interested. This is the only dialogue we've had in 4.5 months. But MEG is basically saying, hey, look, we had this agreement. We gave it to everyone, including you guys. Well, you didn't want to sign it, so we're good. But my understanding is that is following, is that because they didn't sign this agreement and didn't go to the data room, and I would love to hear from the YouTube live guys that looking at the slide and commenting, is that if they did sign, everything stays basically in this room. Notice the initial Cenovus offer was not known to the public. It was in this data room. The $25, nobody knew about this. Now we're learning about it, and we know that it was revised, which kind of makes another question, creates another question. Would that be revised again under a certain situation? The situation could be that maybe there's no approval for the vote, right, in October. So that's remained to be seen. And so we know they increased the offer in the data room, but Strathcona did not even enter the room, and MEG did not engage because they're like, hey, we're engaging with this other 15 parties. Now the key language here is as following. The outreach process was Canadian, US, and international parties that contacted MEG about this transaction. So everybody were basically there at the table, excluding Strathcona. It seems like from basically what MEG shared. On June 16th, the MEG board began a strategic review process. Strathcona approached MEG financial advisors regarding participating in the process. but was told it must sign a standstill agreement. So we know the story aligns. These guys wanted an agreement. This guy said, "Oh, if you want to participate, sign the agreement." Did they sign the agreement? Strathcona was prepared to sign a go-forward standstill to prohibit future share purchases outside of Strathcona formal offer, including, for instance, the 5% of MEG shares it acquired in September. However, the form of standstill discussed with the financial advisor would have made Strathcona existing offer invalid, requiring it to be terminated. Strathcona declined to sign the standstill agreement, such a standstill. Ultimately, only 3 parties signed confidentiality agreements. In negotiating with Cenovus, neither MEG nor its financial advisors came back to Strathcona to ask if its existing bid could be improved. Even if the MEG board had no intention of transacting with Strathcona, such an outreach could have and should have been used to increase competitive tension in what was clearly a weak process. Ultimately, the MEG board agreed to take under with Cenovus and agreed to pay $242 million break fee. So here Strathcona, as of their slide deck today, admits that they are aware of that exact break fee agreement of $242 million. And they say justifiable competitive auction where all buyers have been canvassed for their best and final proposals, but not in this case. So they're saying, hey, this is very unfair. You go with a take under and you sign a break fee with that party that we could have made things much more better for you and your shareholders, and yet yet you did this without talking to us. Now they take the slide. So here's the slide from MEG. Here I'm sharing the slide, and they share it in their slide deck. that's really funny. And they said, fiction. The MEG board ran a robust process to maximize value for shareholders, and they showed their exact slide. So this is their side of the story. Okay. Jack. Okay, thank you. Robert, thank you. Jack. Let's read your comment. A third party bidding all cash 32 per share would end this process and get 50 years asset plus tax loss pools. So we have a comment here from Jack. He thinks all these guys going to be fighting with each other, but then another party comes in, takes everything for $32 per share. Jack, we don't know. Maybe. But by the way, guys, as we talk freely here about what may happen, please go to the beginning of my presentation on YouTube, and I have a disclosure there that none of it is investment advice. Everything is from public domain. And as a community, we're just talking about the MEG perspective, the Strathcona perspective, and trying to understand here what unfolded. We learned a lot here, guys. Would you agree? We learned a lot. We learned about the parties that were interested. We learned about the break fee. We learned about how the board of MEG sees Strathcona, the different dynamics that's taking place. I'm really, really enjoying that space and the YouTube Live. Hopefully you are as well. Okay, continuing with facts versus fiction. So they take another slide from MEG. Let's see what slide this is. So they take this slide. They pick the premium transaction multiple. Okay, so we can see the MEG slide here, and that's the slide they show in their transaction. So they say the MEG Cenovus deal reflects a discount to where MEG was buying its own shares in 2024. So as you may recall, MEG shares were, I think, at about $30-something in 2024. So they're basically using it a little bit against them, saying, hey, you were buying your own shares in 2024. Rather than crystallize value at an unattractive price, Strathcona's offer allows MEG shareholders to fully participate in future upside. In fact, the MEG board deal reflects just a 6% premium to MEG's average buyback. So again, what we see here, guys, a lot, this was not obvious to me, is that we see a lot of baselines. So one company says, hey, your shares are overvalued based on this baseline. And these guys are undervalued. And those brokers like your company and these ones don't. Now we see another assumption is like, based on your average buyback in 2024 during a period in which you underperformed the XEG, this is kind of the deal that reflects just a 6% premium, right? So I think it's a lot of kind of mental gymnastics where you have to kind of really dive in and understand what is being assumed here and what's reality, what's fact versus fiction. So then they say, look, the fiction in the MEG's proposal or MEG's communication to shareholder is that MEG board deal reflects a premium offer, and they say, no, it's not a premium offer. It's only 6% premium. So there's no big premium here, okay? It's not 30 to 40% from that other baseline that Meg said. It's actually 6% from when you were buying shares in 2024. Don't you guys find it intriguing? Like, I think like it's almost like art in a way. It's like, but I respect that. A lot of effort was done to create those slides, to come up with those stories, and advance it to shareholders to decide what's realistic. And they show a chart here basically talking about that baseline and the different buybacks timeframes, and basically questioning is like, well, your stock was declining, you were doing all those buybacks all the way down. What is that premium that you're getting versus that activity? Was it obvious to you guys that this is how they think about this? It was not obvious to me. Okay, fact versus fiction. So Strathcona's fact. Strathcona remains attractively valued versus NAV on both an absolute and relative basis compared to MEG and Cenovus. And they basically showcase here that there's a slide here comparing Cenovus, MEG, Strathcona entity, and Strathcona stand alone, where the median is 100% on the price to after tax 1p reserve NAV, which is a very kind of complicated matrix, right? You take the price after tax 1p reserve NAV. So 1p is basically producible 1p reserve net asset value. So they're not looking at the per flowing, they're looking at the kind of geology, the net asset value in place after tax, and that number, you take that number and you take price and you divide price by that number as of September 12, 2025, including downstream value. And they basically say, look, we remain attractive relatively versus NAV. And you actually attractive too, but we're not too far behind. So then they take, which is again, super funny. They take the exact slide, which we showed and talked a lot about in this presentation. And this is the slide, Cenovus versus Strathcona. And they highlight the implied NAV upside. Now, you would notice, again, the baseline here is that they're saying, no, we don't care about the percent upside versus downside based on implied NAV upside on the valuation, where the brokers come in and say 20% undervalued shares over 30% overvalued shares. No, we don't care about that. What we suggest is that Strathcona remains attractively valued versus the NAV on both an absolute and relative basis compared to MEG on that matrix of price over after-tax 1p reserve NAV. And so they say basically the fiction is that Strathcona is overvalued based on NAV, okay? So again, it's almost like we have to decode the languages here from MEG and from Strathcona to really understand what is the actual NAV and who is overvalued and undervalued based on those assumptions. Okay, I said a lot here. Do we have any comments from the YouTube participants here that on the space? I think there's a lot to comment here about. What do you guys think about this? I think it's very interesting the way they view that. You will never read it on X on a post or by somebody. I think, let me know if I'm doing a good job being unbiased here. I don't want to create like a bias versus one entity versus the other. We want to review both slide decks and display that knowledge and discuss as a community. But what do you guys think about price over after tax 1p reserve NAV matrix where Cenovus, MEG, Strathcona, and Strathcona is compared. So oil investor says, where do the broker NAV come from? It doesn't look like MEG sources the broker report based on the yellow text box. Okay, let's look at the yellow text box. The MEG board claims Strathcona is 30% overvalued and Cenovus is 20% undervalued, based on a single third-party research report, which it does not cite, name, provide a date, or provide details around. So this party now questioning the other party is like, hey, what's your source of that claim? Which is, I think it's valid, right? I think it's a valid comment. Now let's go to their slide deck and see if we can, man, it's such a small print. It probably says there where they take it from. Can you guys go and, while I'm doing this, one of you, and take a look what it says in the small print, what the source for that NAV assumption is? It should be bullet 5. Bullet 5. Because I can't read it from here. But it's definitely there, right? Yes, intriguing. Different point in time, WTI was over $70 and CNQ, and all oil companies were buying back their shares at a higher price. Very balanced, Razor. Thank you. Yeah, I agree, Robert. You know, there was a lot of pressure for buybacks back then, if you recall, right? And Nvidia was going to the moon, and the companies kind of competed, kind of like over that, over the capital allocation, trying to attract investments. And I think in some point, they said, okay, well, we're doing the buybacks. Let's kind of grow a little bit here by the 35,000, maybe not a little bit, maybe by a lot. But then the other angle was the dividend that they issued. So, but if we get the bullet number 5 here on the MEG slide, guys, we will know the source. So then we're going to be able to address Strathcona's concern. As a technical person, do you think proved reserves now from independent evaluators from Strathcona are more reputable than broker estimates? I think they're both kind of vague in a way, oil investor, I would say. Lots of assumptions, right? That's why I think what's really important is the central process facility and how much you can handle, because you have 50-year reserve. Seems like on both sides you have a lot of NAV, you have a lot of oil in place. But like I talked, if you look at my little model again, I'm going to refer you back to this. So you see the injector, you see the producer, you see the steam chamber development. What if you have a heterogeneous zone right here that hinders chamber development, and it's being counted as 2P or 1P? You're not going to get the oil that's remained at the top section of the closer to the overburden, right? Now that's being also counted as oil. Maybe it's being counted as 2P. I don't know if we have technology today to extract that oil, or if there is sufficient heat transfer to produce it, and it's probably being included as at NAV at 2P. But like we said, they're looking at 1P, and then they include the after-tax 1P reserve NAV over price. So lots of, it's a little bit mental gymnastics, so don't you think? Well, okay, thank you. So it's just based on one broker, I guess. Maybe MEG, their next move is like, okay, let's get more brokers and get the same number, right? I mean, you could do that, I guess. Based on third-party research includes the unrestricted broker, which has published NAV per share estimates for both Cenovus and Strathcona. So number 5, that's what it says. So Strathcona is right here. They didn't indicate their source. So maybe this is something they can follow up with and maybe do a better job. And again, this is, I think, the true value of what we're doing here. We're looking into the details and we're driving down to the very small details to understand what each side is thinking. And what we're learning here, guys, is that it's not simple. Nothing here is easy. Nothing here is simple. A lot of mental gymnastics, a lot of assumptions from both sides. A lot of kind of like, that's why you should be with me, that's why you shouldn't be with them. You're based on this matrix, you know. But in my mind, MEG probably just wanted to to be left alone. Like that's what it comes down to. And from the alternative options, they ended up picking Cenovus, I guess, because of the geographic synergies there. Okay, so we have a comment here. Waters makes a good point. I own shares in all three COs and don't know what to do. I've owned CVE when it was part of Pan Canadian, which should have never broken up. Jack, yeah, I worked with many legacy Pan Canadian guys, CS Resources, right, and Pan Canadian that merged. Was a wonderful entity. And Kana, back then, 2002, was the biggest oil company in the world. I agree with you. It was a missed opportunity, and it could have been something very special, but we can't go back. 23 years ago, and Kana was the biggest oil company in the world. Another comment. They both seem pretty undervalued to me, pretty even. Same with CVE. All three look like good buys. Thank you, oil investor. And Jack, I agree. Yeah, that sounds good. I'm glad we have alignment here. Okay, moving on. Fiction versus fact. Junk. Which slide makes more sense, the MEG or the Strathcona slides? So junk. I think what we can tell for sure is that both entities, nobody here is stupid. Nobody here is stupid. Unlike what you hear from one side and another side, nobody here is stupid. Nobody here, I don't think, is negligent. I truly believe, the kind of messaging here is that the board of MEG is not doing their duty to shareholders. If I'm unbiased and just looking from a side and taking a look at their assumptions, I can't really conclude that junk. I can't, because they provide, just like Strathcona does, they do provide their baselines, their details. They explain why this is better. The core, guys, I think the core key part here is really this. It's really this. They said the implied NAV upside is 20% undervalued for Cenovus and 30% overvalued for shares for Strathcona. That assumption alone, if you think about this forward looking, that kind of like gives them the credibility. If they assume that, if this is real, we don't know if it's real. It kind of tells them, hey, I think they think they're making the right decision. And SOR is, well, nowhere close to, based on that comparison, to the Strathcona SORs. Like if you look at the asset comparison, 3.7, 4.5, 3.2, 4.4, right? So they're trying their best to say, like, look, we're in the low twos. We don't want to be with an entity that has, in their words, degraded performance, recent successes, but maybe follow 3 years of weak performance and contrast with the MEG's superb track record from a technical perspective. So they're doing, it seems like they understand what Strathcona's assets are and making assumptions. But again, maybe it's unfair to Strathcona because maybe there will be improvement in those assets, right? Maybe these guys will be optimizing them and improving because of that combined entity, right? So, all right. MEG uses false and deliberately misleading figures to obscure Strathcona's actual historic organic growth. And going back to MEG slides, they're talking about this slide. Again, I was kind of uncomfortable with that slide, to be honest. Like, as somebody that talks about this, I don't want to come across like it comes from me. It comes from that slide and MEG communicating that. But it's somebody that verbally talks about that. I don't have a way to verify this right now, but that's the language they chose. So Strathcona attacks back, and it says MEG attempts to discredit Strathcona track record by using misleading and in some cases wholly incorrect figures. Correcting for this shows Strathcona has achieved measured growth to date in the areas it has invested in, and basically it shows a different trajectory at acquisition and current production, and it does show growth for the Lloydminster thermal assets, Coal Lake Thermal, Lloydminster Conventional, and the three assets we talked about in the Coal Lake and Lloydminster regions, which include Tucker, Orion, and Lindbergh, and kind of the Serafina assets as well. So they're saying, no, we were actually pretty good in growing production, And at acquisition production, 12% overstated by MEG board. No data source provided and production figures do not match public data. Current production reflects Q2 2025, which was heavily impacted by Tucker turnaround. And this is important to talk about. We did see some posts about Tucker having low SOR recently, but this was a turnaround, right? This was them going from, like, I think it was 26,000 barrels a day to 6,000, and cutting steam injection, cutting oil production, going to lower SOR. And so people were getting excited, hey, Tucker is improving SOR, but they really kind of were doing the turnaround. So, which kind of, I give credit to Strathcona here, saying, look, our production did not really decline. We were just doing maintenance. It's going to get restored back. And so your assumption here is not really fair. So, so they say the current production would be 64,000 barrels per day due to Q2 turnaround. So from a technical perspective, I relate here to Strathcona and kind of their messaging when it comes to turnaround programs, basically saying, look, we're not as bad as you say we are. But again, you see a clash of these two companies, right? Like, if they were to merge, if they were to become one company, how do you guys think it's going to unfold for some of the employees, for some of the management, for the board of MEG, or how is that going to be? Is it going to be a friendly relationship, or it's going to be based on the language here that we're seeing? So, fact, Strathcona has grown production in areas it has allocated growth capital to and chosen to maximize free cash flow in areas it hasn't. Fiction, Strathcona has not grown production organically. So that's what they're saying. Okay, PJ, that gives them no credibility. A single cherry-picked broker report, which it does not name source or date. PJ, I think I kind of talked about this a little bit. We need more data. I think you're right. But again, PJ, like, let's say they come up with a name and the date, and they provide all that value. And then they say, also, in addition to that, we have all this data from these other guys that assume the same thing. Would that make things better? Maybe, I don't know. Oil investor says, seems pretty bad to me that they made up 129,000 barrels per day production at acquisition number. Well, I think their angle here was, I don't know if they made it up. Like, I don't have, there's some small language there, adjusted to remove acquired Crown Birch production based on Q2 2025 production volumes. And they compare Strathcona acquired production versus current. I don't know how they made it up. I do remember Serafina being 40,000 barrels per day. Tucker is tricky, but I do know Strathcona did a good job optimizing this asset. I don't remember Kona or Penn growth exactly, but I don't know. I don't know if they made it up, but clearly Strathcona is very unhappy about that here, and they're saying, "Look, this is fiction." I think they did a really good job with Tucker. Let's be honest about that. By the way, for guys that are listening on Spaces, I'm on YouTube Live, looking through Strathcona and MEG slides, public slides, and just talking about them, and communicating with the community, trying to better understand what's taking place here. Okay, John from Twitter says, I'm not a fan of STHRF, but Adam is shrewd businessman. He owns the Waters Energy Fund that owns Greenfire, impressive, and STHRF. For sure, he is a remarkable businessman. He is an amazing businessman. You cannot take it away from him. Phil says, John, it's too late to do that when CVE popped after the deal was announced. And John said, what if you took the cash portion and reinvest into CVE so that the MEG shareholders, we can capture all the gains? So that was kind of the comment for which was responded, and we talked about that as well already. Okay, so again, lots of conflict here. Boom, boom. Okay, Strathcona, again, we go to fact versus fiction. Strathcona's success after acquiring Tucker from Cenovus demonstrate why SOR is only part of the story. MEG continues to claim SOR is the sole driver of SECD profitability. Now, I'm a huge advocate for SOR as part of the metric, right? That's my personal view. I think it's an important metric, but I do agree with Strathcona here that it's not the only metric, of course. When it's only one of many factors. Fortunately, this misconception allowed Strathcona to buy Tucker from Cenovus, earning strong returns for its shareholder. So here they basically show the uplift in production because of the LDW. So my understanding, those will be, I think they call them maybe long drive wells or something. Those are basically long infill wells. So if we have the steam chamber again, you can see my model. They're talking about this infill well on the side of the well pairs, injector producer infill, and they basically drilled a bunch of those. Heat was transferred from the chambers, and you can see the uplift in the production oil rate, really. So that's kind of what they're alluding to here. And they talk about the operating netback, which is close to $40, which is amazing, right? So I think it makes a lot of sense. So here, let's read a little bit more. Largely due to success of lower drainage wells. Oh yeah, so lower drainage wells, they basically drill lower infill wells. Now, my understanding, Cenovus is the company that kind of commercialized this idea. So maybe Strathcona should kind of revisit their language here, because my understanding, Cenovus has like an idea that they kind of worked on being lower draining wells. So maybe I'm opening like a can of worms here, but it is what it is. So this is something they do as well. Maybe at the end, they all end up merging as well. Strathcona, Cenovus, MEG, I don't know. Maybe they all can be like very happy family one day. So here they talk about, hey, SOR is not the only metric, right? We have more. Netbacks are important. The challenge, of course, here, and I will be kind of very open about this, is like, what does the future SOR looks like? So if we have a steam chamber and we put the geology here, and maybe complex geology, that SOR could be probably increasing over time as the geology degrades, right? So can you recover those upper sections of the steam chamber, right? We talked about this a little bit. More like 2P, 3P reserves. But operating netback been pretty good. Now, again, important comment. You have very limited amount of those injector producers and infill well opportunities. So this was probably utilizing the existing locations. Are those locations going to be continuing kind of to exist there over the course of time? That may or may not be happening, right? So they're going to have to drill actual well pairs in the future to optimize the production further. 35% of production growth since acquisition, from 19,000 barrels per day to 25, which is current, largely due to success of the lower drainage wells, first piloted at Orion. 30% reduction in steam-to-oil ratio from 5.1 to 3.6. So that's pretty good, right? That's, by the way, what Hanging Stone at Tabasco asset was able to achieve. So, which kind of, I think maybe these guys are next. So 650 million, 220 over the 3 years of free cash flow. By the way, obviously when the oil prices were higher, so yeah, you realize that netback, but we're not in the price environment right now. 90% of purchase price after effective date adjustment, 20-year remaining to PRLI. So that's from, I assume, from their slide deck. And the key message here suggesting, look, SOR is not the only metric. Operating netbacks are also important, which is fair. Okay, so we're slide 7 now. While Strathcona may not be a Bay Street favorite yet, historically this has had little, no correlation with returns. So they're showing XEG versus Cenovus versus Strathcona. MEG claims Cenovus stock is superior because it has more buy ratings, but they also claim that it's undervalued, right? So meaning that will be fairly valued in the future, which creates upside. While Strathcona appreciates the work of the few analysts which cover it, analyst target prices are often more correlated with volume traded than intrinsic value. So the fact they say that Cenovus has been an analyst favorite for years but has underperformed in Strathcona's small trading volume has made it an unnatural fit for the sell side. So fiction, analysts' buy ratings predict future share performance. So that's kind of what they're saying here. Okay, the other angle, MEG is refusing to have any dialogue with Strathcona so that it can claim ignorance over Strathcona and Water Energy Fund actual intentions. MEG has restored to baseless claims around Water Energy Fund intentions rather than engage in a constructive dialogue to address concerns. Water Energy Fund remains open to signing a lockup and adding additional independent board members. In fact, the WEF remains a supporting long-term shareholder of Strathcona and would be happy to negotiate a lockup and board representation with MEG. In fiction, Water Energy Fund Strathcona ownership is inherently bad for shareholders. So basically, they're picking kind of on these slides for MEG here and basically saying this is fiction, this is not real. We want to be kind of long-term participants here, right? And again, you can see the challenge with Strathcona, right? Median daily trading value, trailing months. Obviously, the combined entity will be trading more volumes based on Strathcona MEG kind of combination, but right now, very small kind of float on the Strathcona side. Okay, let's read some comments. Eric Nuttall thinks MEG is being stolen. Oil investor, are you surprised Tucker has a better netback than MEG in the same as CV oil sands? I would have thought it will be well lower due to SOR. So this is not entirely true, I think. So what's happening here is that companies are growing production, allocating, like we know MEG is deploying capital to grow their production, right? And so I don't know if this netbacks comparison is kind of fair. Let's say if they didn't grow any production, they didn't deploy any allocation to anything additional, would they have more netbacks or less? So I think that will be a fair kind of comparison. Also, it's important to kind of consider that pre-payout, post-payout status, one day Strathcona assets will be post-payout status, so they will pay less taxes, less royalties, more taxes, more royalties, right? Yeah, especially if they run out of tax pools. So it's important kind of to consider that MEG is kind of getting into that post-payout. I think they're already kind of there. So so I don't know if it's like a fair comparison, to be honest, right? Hopefully it makes sense. So we have here appendix, fact versus fiction, the original slides. Again, let's kind of go quickly over that. This was the original, and they basically, we committed to talking about the updated version. We 2 hours, 20 minutes into that. So let's kind of quickly go over fact versus fiction and give both entities like an hour and an hour each to showcase each point of view. And I think this way it will be fair to everyone. But I think, guys, we did a really deep dive here, really trying to understand both sides. Okay, so to conclude, fact versus fiction. MEG's director circular contains a variety of claims which misunderstand Strathcona's business. Strathcona remains ready and willing to engage with MEG board in good faith. Fiction, MEG assets have premium netbacks to Strathcona. Fact, both Strathcona and MEG have great assets, with Strathcona having slightly higher netbacks. We talked about this, the assumptions, post-payout, pre-payout status, allocation of capital, it depends, right? So fiction, fact, one side could argue precisely the other thing. They could say, well, if we didn't do this, this, and this, and we were pre-payout, we could have been better. Or if we didn't allocate this capital here, based on year 2022 netbacks, we were more. And because you were optimizing with infills here, you see everybody capturing the time frame where it's convenient for them, right? But reality is the geology at Christina Lake MEG is homogeneous, way more homogeneous to all other heterogeneous Strathcona assets. And that's really comes in the form of higher SOR metric, right? That's kind of what the indicator is. And reality is Strathcona is pursuing MEG. MEG is not pursuing Strathcona. So we have to be mindful of, I mean, I understand what Strathcona is trying to do. They want MEG, but they're also saying They're basically twins, but there are lots of kind of moving parts here that are not really comparable from that perspective, in my personal view, if you guys care about my view. Fiction, MEG has lower cost than Strathcona. Fact, Strathcona and MEG have similar total costs, but in different categories. Exactly. That's exactly what I'm talking about. That's what I was alluding to. With Strathcona, lower cost overall. So that's what they're saying. Fiction, SOR is primary driver for SECD profitability. Fact, many factors contribute to SECD profitability. Stronger realized prices outweigh higher OPEX. But again, my question to you is like this. Cardinal Energy is building now referred asset, okay? They, in Saskatchewan, they're going to be producing 6,000 barrels a day. If you take SOR 3 for 6,000 barrels a day, that's 18,000 barrels of steam requirement, right? That's capital. That's capital that needs to be allocated to produce 18,000 barrels of steam to be injected. And then at the back, you produce those barrels. It's part of the emulsion, and you need to do something. You need to handle, separate the oil, maybe re-inject, maybe dispose, all that water in perpetuity, like in forever. Like as long as this asset exists, you have to handle that additional water. So 18,000 barrels per day, considering SOR 3. But if you SOR 2, you need only 12,000 barrels per day of steam to be injected and handled in perpetuity, right? And so SOR is primary driver of SECD profitability as a fiction. Well, think about the CapEx perspective, right? If you need to allocate that capital to build the facilities to handle that water or produce that steam to be injected. How, from a CapEx perspective, SOR is an extremely important metric because it literally dictates how much CapEx you're going to be spending for your operations, right? Or, for example, if you were to design facilities for 18,000 barrels per day and you were to produce only 1,800 barrels per day, your SOR is 10, and you basically very energy intensive. You're not making the netbacks based on the oil production rates, which could hinder your operations and your profitability. So I think SOR is really misunderstood. But I do see what they're saying here too. Is capital allocation, realizing prices in Saskatchewan outweigh higher OPEX. The other thing I think maybe they don't consider here is that the Christina Lake synergies that could be realized by geographically by combining and exploiting reservoirs as per my model that are more clean, more homogeneous. Maybe it's not well understood for Strathcona, or maybe it is. I don't know. But listen, this is not their job to understand it. They just want MEG, right? So it is what it is. But MEG has their own incentive. They want to, in a way, or maybe we should believe that they behave to make shareholders profitable in the future, right? So on behalf of the shareholders, where on X we hear a lot that the board doesn't do that. And based on these slides, I just don't believe that. I think everybody doing their best. I think Strathcona is doing their best to get MEG. I think MEG is doing their best to not to be acquired by Strathcona. And to be honest, I think MEG just wanted to be left alone, to be honest. Okay, next fiction. MEG has significantly more high-quality inventory than Strathcona. In fact, Strathcona and MEG have similar inventory and break-evens. Okay, but again, heterogeneity, right? Reservoir heterogeneity is important as we look forward. Not today, as we develop the future reservoirs here. The 1P, the 2P assumption, the 3P. What if you have a lot of heterogeneity here, 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 there, and you count all this stuff as oil, but maybe you can't produce it, or you need to spend more capital to introduce more wells? I do believe that in this case, based on numbers, based on permeability, porosities, reserves, based on what I've seen with my own eyes, Christina Lake region generally have better high quality inventory. I don't think it's a fiction. Okay, fiction. Strathcona primarily sells its oil via rail, which inferior to MEG's long-haul pipe contract. In fact, Strathcona sells a portion of its oil via rail at a premium and has a third-party rail business, which they recently acquired, by the way. Fiction. Having a large shareholder on the board of directors is inherently a negative. Fact. 9 out of 10 MEG board members have little alignment with their shareholders. Guys, we covered so much today. We talked about so many angles to this transaction, to this offer, to the dynamics here. I find on X, on Twitter, people that don't understand this businesses very well, that don't understand what I just talked about from a technical perspective, really anchor themselves to this one thing: board alignment with shareholders. Do I think board has enough shares that they were holding as MEG shareholders? I don't think MEG board had enough shares to say we're like true supporters of MEG Energy. I think it's in public domain, and we can all see that the board members for MEG could have had more shares. But what's done is done and cannot be undone. So I do agree here that maybe the alignment when it comes to being a shareholder could be questioned. But based on the slides that MEG shared and their points on what's going on here, I don't think they behave not on behalf of the shareholders, if that makes sense. Like, I believe they're doing their best to create value for shareholders in a strange way. And please write me in the comments for the stream on YouTube if you think otherwise, because I'll be concluding the space very shortly. And it's time maybe for final comments based on everything you've seen, based on everything you learned and observed. Maybe it's an opportunity to kind of close the space. What do you think? What did you learn? And what do you think is appropriate here and makes sense? And the final fiction comment is whether Energy Fund is planning to sell all its shares in Strathcona, where the fact is that Water Energy Fund plans to continue distributing shares to its LPs, which has been positive for Strathcona thus far. Okay, that's another big fear MEG communicated, that they're like, no, as soon as they buy us, they're going to dump the shares and we're going to get hurt. Where Strathcona openly shares here, hey, we're not going to do this. And in fact, we're going to hold the shares. And then our LPs are seeing basically the distribution of the shares, continuing distribution of the shares to them as positive for Strathcona. So that kind of concludes, I guess, this was the first presentation they made. So there are a bunch of advisories here, guys. Please look on both companies' websites. Pause the video if you have to for the advisories, for the assumptions. Very important. So I'll give an opportunity for everyone to make comments on X, to make comments on the chat, so I can share those comments. Here's my disclosure that this is for informational and educational purposes only. Does not constitute investment advice, and really important that we learned a lot from those slides. I think I personally learned a lot. Okay, so let's read some of the comments and go from there. So I don't see any comments on the space. Okay, let's see here. Okay, yeah, I shared all comments, so I liked all comments that were shared. So thank you again, Phil. Thank you, John, for your comments on X and your input. Anybody here on the stream that wants to kind of share their thoughts? Something maybe interesting they learned? Fact versus fiction. Give you a couple more seconds. If not, we will conclude our space here. The sequel, fact versus fiction. Let's see what happens, guys. Okay, Robert, thank you, Razor. I appreciated your balanced delivery. I think I understand that CVE may have a larger upside because of the synergies in Christina Lake assets. Yeah, for sure, Robert. I think the Narrows Lake. So here's my call. I'm gonna say something controversial. This is my call. If Cenovus is successful in acquiring if Cenovus is successful in acquiring MEG, the MEG Christina Lake asset will be called Narrows Lake. So when they report in their quarterly earnings production, the central process facility will be named something else, and they will be able to develop that region there. Even though they did, in my understanding, kind of connected their CPF via a big steam pipe to that region going around the lake. You can't really drill through the lake. There's lots of regulation, but they're going to call it Narrows Lake, I think. So there will be Foster Creek CPF, Christina Lake CPF, and Narrows Lake CPF. That's the value for, I think, Cenovus. And for MEG, we learned today that there were many parties that were interested in them. We learned about that. And we also know they're going to go to 150,000 barrels per day because of the combined entity. So we learned about that. It's not going to be 135. So I know lots of people had lots of pushback. It's like, why are you brownfielding? Jack, learned a lot, but as a shareholder, still don't know what to do. And Jack, that's the challenge, right? Nobody is here is not stupid or naive, or everybody's here. All these people that made the slides are smart people. They know exactly what they're talking about. They know exactly what they're comparing things to. They know exactly what matrix the other company is looking at. The board from MEG knows what they're doing. Their technical staff know. Same with Strathcona. Everybody is aware of everything, but we have this game that unfolds here, right? That's intriguing to watch. And unfortunately, Jack, your comment is correct for many people. Many people don't know what to do. They just don't know what to do. But reality is that we're converging, and there will be a decision. What the interesting scenario that could unfold here is that what if the merger in October is not, well, the acquisition by Cenovus is not happening because Strathcona blocks it. For me, this is the intriguing part. Like, what happens next, right? What will happen after that? Do they? Well, they're not going to sell their shares, so like, why would they? Will they increase the offer? Would the other party increase? Would there be a third party that will come in? We have a comment here that I already shared, but I want to reshare it again because I think it was a very good comment about so this one. Third party bidding all cash $32 per share would end this process and get 50 years assets plus tax loss pools. Yeah, maybe. We don't know. Thank you, PJ. Thanks for your comments. Thank you, Robert. Thank you, Jack. Thank you, Oil Investor. If CV switched to all shares, I would vote for them. But until then, I like Strathcona share offer. Oil Investor, this is very, kind of subjective, right? It's a very unique, kind of unique to you situation because lots of people want cash, see it as attractive. The tax structure, may not benefit maybe some people, but what are you going to do? Okay, friends, again, disclosure, entertainment, information only, not investment advice. Hopefully it was helpful. We reviewed slides from the public domain, tried to educate ourselves, tried with the community connect, share both sides of the story. Hopefully I didn't come across as somebody that's biased about this by any means. Tried showing the MEG side, tried showing the Strathcona side. One thing is for sure, on X we see sometimes posts. This presentation encourages everyone to be a little bit more understanding of the other side, I think. Not everything is like one-sided, like these guys are idiots and these guys are not idiots. No, I think smart people on both sides. Final comments. My prediction, whoever wins MEG takeover will outperform the other company. Maybe, PJ, we don't know. Maybe. Merci. Merci beaucoup. All the best, everyone. Thank you.